Welcome. Today we're diving into the world of mortgage regulations, focusing on high-cost mortgage loans (HCML), high-price mortgage loans (HPML), and qualified mortgages (QM). Understanding these rules is crucial for anyone working in real estate lending or even just buying a home. We'll break down the key features, criteria, and differences among these loan types and explain how they impact borrowers and lenders. By the end, you'll have a clear grasp of what makes a mortgage high-cost, high-priced, or qualified, and why these distinctions matter in the lending process. Let's get started by exploring the basics of each category. High-cost mortgage loans, or HCMLs, are regulated under Section 32 of TILA and HOEPA. These loans come with strict requirements to protect borrowers from predatory lending. The rules are designed to ensure that borrowers are not subjected to excessive fees, high interest rates, or unfair loan terms. HCMLs are not a specific loan program, but rather a classification based on certain features and thresholds. If a loan meets or exceeds these thresholds, it's considered high cost and must comply with additional consumer protections. Let's look at the features that define an HCML. Remember the main features of an HCML. Think of the acronym BAPS: no balloon payments, ability to repay, no prepayment penalties, and must speak to HUD counselor. These requirements are in place to ensure borrowers fully understand their obligations and are not caught off guard by hidden fees or penalties. The ability to repay rule is especially important, as it requires lenders to verify that the borrower can realistically afford the loan. No balloon payments and no prepayment penalties further protect borrowers from financial surprises. Loan is classified as high cost if its annual percentage rate (APR) exceeds the average prime offer rate (APOR) by certain margins. For first lien mortgages of $50,000 or more, the APR must be at least 6.5% higher than the APOR. For first liens under $50,000 or for subordinate liens, the threshold jumps to 8.5%. These thresholds are set to catch loans with unusually high interest rates, signaling a need for extra scrutiny and consumer protection. Another way a loan can be considered high cost is if the points and fees exceed certain limits. For loans of $26,968 or more, points and fees must exceed 5% of the total loan amount. For loans under $26,968, the threshold is 8% or $1,348, whichever is less. These limits are designed to prevent lenders from charging excessive upfront costs, which can quickly make a loan unaffordable for many borrowers. High-priced mortgage loans, or HPMLs, are covered under Section 35 of TILA. Like HCMLs, HPMLs are not a specific loan program, but a classification based on certain features. The rules for HPMLs are designed to protect borrowers from loans with higher than average interest rates, but the thresholds and requirements differ from those for HCMLs. Let's explore what makes a loan high-priced and the protections that come with this classification. Main features of an HPML can be remembered with the acronym APE: ability to repay, no prepayment penalties after 2 years, and escrow for 5 years. The ability to repay rule ensures the borrower can afford the loan. Prepayment penalties are limited to 2% of the outstanding balance and only allowed within the first 2 years. Additionally, HPMLs require an escrow account for property taxes and insurance for at least 5 years, unless the loan-to-value ratio drops below 80% and payments are current. For a loan to be considered high-priced, its APR must exceed the APOR by specific amounts. For first lien loans, the threshold is 1.5% above APOR. For first lien jumbo loans, it's 2.5%, and for subordinate liens, the threshold is 3.5%. These lower thresholds compared to HCMLs mean that more loans may fall into the HPML category, triggering additional consumer protection. HPMLs may require an additional appraisal in certain situations. If a home is sold within 90 days and the buyer is paying at least 10% more than the previous sale price, or within 180 days with a 20% price increase, a second appraisal is needed. This rule is designed to prevent property flipping and ensure the property's value is legitimate, protecting both the lender and the borrower from inflated prices. Qualified mortgage, or QM, is a loan that meets specific standards set by the government to ensure the borrower's ability to repay. QMs are designed to be safer and more stable for both borrowers and lenders. If a loan meets QM standards, it is presumed to comply with the ability to repay rule, offering legal protections to lenders and peace of mind to borrowers. Let's look at the criteria that define a QM. Qualified mortgages have specific thresholds based on loan amount and interest rate. For loans of $134,841 or more, the APR can be up to 2.25% above APOR. For loans between $80,905 and $134,841, the threshold is 3.5%. For loans under $80,905, or for manufactured homes under $134,841, the threshold is 6.5%. Subordinate liens over $80,905 have a 3.5% threshold. These rules help ensure that QMs are not excessively costly for borrowers. It's important to remember that HCML, HPML, and QM are not specific loan programs. Instead, they are classifications based on the features and terms of a loan. If a loan meets the criteria for one of these categories, it must comply with the associated rules and protections. This approach helps ensure that borrowers are treated fairly, regardless of the loan product they choose. Great way to memorize the differences between HCML, HPML, and QM is to use flashcards. Focus on one category at a time, reviewing it multiple times a day until you have it down. Once you've mastered one, move on to the next, but keep reviewing the previous ones to reinforce your knowledge. This method helps you retain the details and quickly recall the key features when needed. Understanding regulatory language is crucial. Terms like prohibited mean not allowed, while permitted means allowed. Watch out for double negatives such as not prohibited, which actually means something is allowed. Similarly, least likely means it's probably not the answer, while most likely points to the correct choice. Being aware of these nuances can help you interpret rules and exam questions more accurately. In the past, mortgage loan originators, MLOs, could earn more by charging borrowers higher interest rates. Today, if a borrower accepts a rate above par, the lender must provide a lender credit to offset closing costs. This change ensures that borrowers are not unfairly penalized for higher rates and that compensation is more transparent. Mortgage regulations have evolved over decades. Notable milestones include the creation of FHA in 1934, Fannie Mae in 1938, and the introduction of TILA and fair housing in 1968. Other key laws include RESPA, ECOA, HMDA, CRA, and more, each adding layers of consumer protection and industry oversight. Understanding this timeline helps put today's rules in context. When it comes to property ownership, states follow either lien theory or title theory. In lien theory states, a mortgage creates a lien on the property and the borrower holds legal title. Foreclosure must go through the courts, making it a judicial process. In title theory states, a trust deed is used and a trustee holds legal title while the borrower holds equitable title. Foreclosure is non-judicial, handled outside the courts. Remember, mortgage equals lien theory, trust deed equals title theory. Lien theory states the mortgage involves two parties, the mortgagor borrower and the mortgagee lender. The borrower holds legal title, but it's encumbered by the mortgage lien, limiting their ability to sell or transfer the property freely. The lender holds the mortgage and promissory note. Foreclosure must go through the courts, making it a judicial process. A lease pendens is filed to start foreclosure proceedings. Title theory states use trust deeds and involve three parties, the trustor borrower, trustee neutral third party, and beneficiary lender. The trustee holds legal title while the borrower holds equitable title, giving them the right to live in and build equity in the property. Foreclosure is non-judicial, handled outside the courts, making the process faster and often less costly. There are several types of deeds used in real estate. A quitclaim deed is often used between familiar parties and offers little legal protection. A deed of trust is used in title theory states. Warranty deeds provide strong protection for buyers, while grant deeds guarantee ownership but only protect against unknown liens. Bargain and sale deeds offer no protection, often used in foreclosures. A mortgage deed is tied to lien theory, and a reconveyance deed is used when a loan is paid off. Variable rate loans use different indexes to determine interest rates. COFI is used for calculating variable rate loans, COSI for ARMs, and SOFR has replaced LIBOR as the standard for overnight borrowing costs. The U.S. Treasury rate and prime rate are also important benchmarks, especially for credit cards and auto loans. Understanding these indexes helps borrowers anticipate how their rates might change over time. Wraparound mortgage is a type of seller financing where the borrower pays the seller directly. The seller then uses those payments to pay the existing mortgage, which remains in the seller's name. This arrangement allows the buyer to live in the home while the seller retains liability for the mortgage. It's not the same as rent to own, but it offers a creative solution for buyers who may not qualify for traditional financing. Purchase money mortgages occur when the seller provides part of the financing for the buyer. This is common when the buyer can't secure a loan for the full amount. A seller-held mortgage is a temporary loan from the seller, often used as a bridge until the buyer can obtain traditional financing. Both options provide flexibility in real estate transactions, especially in challenging markets. Mortgages and trust deeds contain various clauses that define the rights and obligations of both parties. Understanding these clauses helps borrowers know what to expect and how to protect themselves. Let's break down some of the most important clauses you'll encounter in mortgage documents. Alienation clause, due on sale clause, and acceleration clause all allow the lender to demand full repayment of the loan. Alienation and due on sale are triggered when the property is sold or transferred, while acceleration is used when the borrower defaults. Due on sale is specific to conventional mortgages and makes the loan non-assumable. Acceleration is only used in cases of default. An escalation clause allows a buyer to increase their offer if they are outbid, similar to a silent auction or eBay bidding. This clause is often used in competitive real estate markets, giving buyers a chance to stay in the running without constantly renegotiating. It's a strategic tool for buyers who want to secure a property in a hot market. Repayment privilege and prepayment penalty clauses determine whether a borrower can pay off their loan early without a fee. A prepayment privilege clause allows early payoff with no penalty, while a prepayment penalty clause imposes a fee for early repayment. Knowing which clause applies can save borrowers money and help them plan their finances. The defeasance clause comes into play when a borrower pays off their loan in full. It requires the trustee to transfer legal title to the borrower, effectively defeating the trust deed. This clause ensures that once the debt is satisfied, the borrower gains full ownership of the property, free of any liens. An open-end clause allows for future advances from the same line of credit. This feature is found in HELOCs, home equity lines of credit, and reverse mortgages. Unlike closed-end loans, which have a set end date and amortization schedule, open-end loans offer flexibility for borrowers to access funds as needed. The power of sale clause is found in trust deeds and gives the lender the authority to foreclose on a property without going through the courts. This non-judicial process is faster and less expensive than judicial foreclosure, making it a common feature in title theory states. Subordination clause allows a senior mortgage to assume a junior lien position, usually when refinancing. The order of liens is determined by the filing date, and this clause ensures that refinancing doesn't disrupt the priority of existing liens. It's an important consideration for both lenders and borrowers during refinancing. If a foreclosure sale doesn't cover the full amount owed, a lender can seek a deficiency judgment to recover the remaining balance from the borrower's assets. However, if the loan includes an exculpatory clause, the lender cannot pursue the borrower's other assets. Understanding these clauses helps borrowers know their potential liability in foreclosure situations. A conversion clause allows a borrower to convert an adjustable-rate mortgage arm to a fixed-rate loan at a specified point during the loan term. This option provides flexibility for borrowers who want to lock in a stable interest rate after starting with an arm. Partial release clause is used in blanket mortgages which cover multiple properties. This clause allows individual parcels to be sold and released from the mortgage as they are sold, giving builders and developers flexibility to sell properties without paying off the entire loan. An assumable mortgage clause allows a new buyer to take over the seller's existing loan, releasing the original owner from liability. This process, known as novation, can make it easier for buyers to secure financing, especially if the existing loan has favorable terms. A recast clause allows a loan to be adjusted and become fully amortized again, often after a significant payment is made. This can help borrowers reduce their monthly payments and pay off their loan more efficiently. FHA offers several loan programs, each designed for specific needs. The 203B is a basic fixed-rate loan, while the 203G is for good neighbors like teachers and first responders, offering them a discount. The 203K is a rehab loan for home improvements. The 234C is for condominiums. Each program has unique features to help different types of borrowers. FHA 245 program is a graduated payment mortgage (GPM), ideal for borrowers expecting their income to rise over time. Payments start low and increase annually. The 245A is a growing equity mortgage (GEM), which is fully amortized from the start with payments rising each year to build equity faster. The 251 is an adjustable-rate mortgage ARM, offering flexibility for borrowers who expect rates to change. FHA 255 is the Home Equity Conversion Mortgage (HECM), also known as a reverse mortgage. It's available to borrowers aged 62 and older with significant home equity. Instead of making payments, the borrower receives payments from the lender, helping seniors access their home's value for retirement. The FHA Streamline program allows for easy refinancing with no income, credit, or appraisal requirements. It's a fast way for borrowers to lower their interest rate. The 2-1 buy-down temporarily reduces the interest rate for the first 2 years, making payments more affordable at the start of the loan. The Energy Efficient Mortgage (EM) allows borrowers to finance improvements that make their home more energy efficient. This program helps homeowners save on utility costs and increase their property's value, all while supporting environmentally friendly upgrades. Mortgage disclosures have different tolerance levels for changes between the loan estimate (LE) and closing disclosure (CD). Zero-tolerance items like real estate transfer taxes and appraisal fees cannot change at all. 10% tolerance items such as title insurance from a lender's list can change up to 10%. No-tolerance items like per diem interest and hazard insurance can change by any amount. Blockbusting, also known as panic selling, occurs when real estate agents spread rumors that a specific ethnic group is moving into a neighborhood, causing homeowners to sell quickly out of fear that property values will drop. This unethical practice is illegal and undermines fair housing laws. Redlining is when lenders refuse to make loans in certain neighborhoods, often based on income or ethnicity. Reverse redlining is the opposite, where lenders only offer loans in high-income areas. Both practices are discriminatory and violate fair lending laws, reinforcing inequality in housing. Steering occurs when real estate agents or lenders direct clients toward or away from certain neighborhoods or loan products based on personal characteristics. This practice is illegal and undermines the principle of equal opportunity in housing and lending. Always be aware of steering and report any suspicious behavior.